Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. We're going to start off looking at the UK inflation number, which led to the Bank of England interest rate increase. We're then going to turn to MRB research, which has been an inflation hawk for a long time. So it'll be interesting to see what their outlook on inflation is and also their macroeconomic observations generally. And then we're going to turn to emerging markets because it looks very much like they have dealt with the inflation threat far more effectively than developed markets. So it'll be interesting to see what Neil Shearing, the chief economist at Capital Economics, has got to say about that and the implications for emerging markets. Of course, we do have EM exposure in the Far East specifically. Let's start off with the UK inflation headline CPI up a tremendous 0.8% month on month. Core CPI up even more, which is worrying. So core CPI excludes the food and energy prices, up 1.1% month on month, increasing the annual rate from 6.2% to 6.8%. So that led a couple of days later on the 22nd of June to a much higher, more hawkish policy meeting and interest rate hike from the Bank of England. 50 basis points. They had increased by 25 bips in the prior two meetings. So lifting the rate from 4.5% to 5%. It had been 0.1% 13 meetings ago. So over 13 consecutive increases, the BOE base rate increased from 0.1 to 5%. That's pretty hectic. And what do MRB say about inflation? Their tune hasn't really changed, but one thing that is worth noting is that they have been categorically correct, far more correct than other analysts. So we're very fortunate to be subscribing to their research and definitely far more correct than developed market central banks. So this is what they've got to say, and I think we should listen closely to what they have to say, considering their track record so far. The global economic backdrop, particularly the strength in hiring intentions in the major economies, warns that inflation is going to remain well above pre-pandemic levels for the foreseeable future. Thus, we expect another round of higher policy rates and bond yields ahead. And the persistence of strong labour demand in the face of considerably higher policy rates in most developed market economies reflects solid underlying corporate profitability. Business executives are much more upbeat about prospects for their individual companies due to ongoing good demand and their ability to pass on higher input costs to end users, which is reflected in higher inflation. A similar pattern of willingness to spend due to their own positive income and balance sheet trends exists in the US and Euro area consumer sectors. After the sizable equity de-rating last year, we expect another, albeit less extreme, period of de-rating once bond yields and rate expectations break to new highs. And this is a particularly worrying data point. It's the Manpower Employment Survey of the large global companies. And that survey showed broad-based strength in hiring plans for the third quarter. The most surprising part of the Q3 Manpower survey was that hiring intentions actually strengthened meaningfully rather than moved lower as seemed likely to be the case. The Manpower survey decisively dashed hopes for those betting on a recession in 2023. So they've got some interesting comments on what data points we should really be looking at in order to guide us in our investment decisions. To help time the turning point of this cycle, investors should focus on hard economic data, especially hiring intentions and layoffs. As has been evident over the past year, relying on actual business and consumer sector decisions have provided a better guide to economic and inflation trends rather than following sentiment gauges and the misplaced secular stagnation narrative. So interestingly enough, they feel that gold prices could be a useful barometer. If gold prices were to decline, even as the dollar erodes, then this would represent a strong indication that overall monetary and economic conditions were finally becoming restrictive, i.e., higher real rates, higher bond yields, constraining economic activity. But for now, bullion prices are holding up. Credit spreads are tightening, equity markets are still trying to grind higher, and government bond yields are holding below their peak levels for this recent cycle. So it means that all is good for the moment, but we obviously need to look at that hard economic data, bond yield spreads, possibly even the gold price. Policymakers in advanced economies remain resolutely in tightening mode, while those in emerging markets appear to be shifting to a more dovish position. What is going on? Well, emerging markets, their initial response to the surge in inflation coming out of the pandemic was very different to that of policymakers in advanced economies. They didn't wait to find out whether the initial pickup in inflation would be transitory. They just got on with raising interest rates. Their response to the post-pandemic inflation surge came straight out of Economics 101. They tightened policy quickly and aggressively. This contrasts with developed markets, where interest rates came later and smaller increments. As a result, interest rates in major emerging economies peaked at well above estimates of the neutral level. Interest rates in major advanced economies have taken longer to get there, and the gap between the current level and the neutral level is far smaller. Accordingly, core inflation in most emerging markets is now decisively on a downward trend. This contrasts with major advanced economies. So what does this mean? Well, of course, it means overweight emerging markets in global equity portfolios. Earnings will improve, policy conditions will be more equity friendly, and valuations are attractive. So let's turn now to very bullish, promising revisions from Capital Economics to their Standard & Poor's 500 forecasts. We think investors' enthusiasm about AI has room to grow even further over the next couple of years. New technologies, even those that have turned out to be genuinely transformative, have often manifested in the inflation of bubbles in stock prices in the past. We are increasingly of the view that we're seeing something similar now, or at the very least, that we are in a period in which enthusiasm about AI technology could grow further and provide a strong tailwind for equity indices more broadly. We still expect the S&P to fall over the rest of this year, albeit to a slightly higher level than we'd anticipated previously. But we doubt the pain would last long. By next year, we think worries about growth will be fading, and what's more, the Fed will probably be in easing mode. That could create a backdrop for enthusiasm about equities and AI specifically to recover. So that's all from my side, Gielie. All good at your end.
Hi, Nick. Yeah, thank you very much for a very interesting and comprehensive macro overview. And I like the remark that we must trust hard data rather than sentiment. That's very true. There was a few updates. FirstRand, they reported a surge to credit card sales as more and more entry-level consumers choose credit cards over cash. It means that consumers are using costly credit to make ends meet. FirstRand and Standard Bank both reported in a voluntary update a better than expected revenue growth. The banks are doing well, while the consumers are definitely struggling. Investec in the UK reported that a combination of Investec Wealth and Investment with the Rathbones Group is progressing well, and the completion of the transaction is expected to be completed before the end of the year. And this is a very good deal for Investec. The inflation rate was announced. The inflation for May was 6.3%. That's down from 6.8%, which is positive. And the core inflation rate for May was 5.2%. It's down from 5.3%. The inflation rate is now at the 13-month low and is even below forecast. Analysts didn't expect that inflation would go down so quickly.